Hi guys, welcome back to my channel. Kelvin here. So it's that time of the year again where the market is super red, like it's trying to dress up for Chinese New Year. As of last week, Nasdaq has its worst week since 2020. Bitcoin and Ethereum had dropped to its 6 months low. And everyone was like, sell crash So in this video, I want to explain what's causing the market to go down so much these past few weeks. Then I will tell you what to expect in 2020. Finally, I will share what's my investment plan going forward. But before I start, I would greatly appreciate it if you can help to tap the like button. In return, I will show you a super big God of Fortune at the balcony. Alright, let's start right now. I'm sure you guys are wondering, what started this whole crash? Is it aliens? No, it's even scarier than that. It's actually the Fed planning to increase the interest rate. Story time, at the start of 2020, when everything was going well, people were meeting friends, traveling around the world, having 500 people weddings, and all of a sudden, the pandemic came. People were getting sick, some unfortunately passed away, and countries had to close their borders. As a result, the market was in full panic mode. It was crashing left and right, because paper handlers will always be paper handlers. The Fed saw this and be like, there's soap, pump it, and activated their unlimited money printing cheat code. So in March 2020, the Fed announced that they will keep buying bonds in order to support the market. Guess what? Not only did it support the market did a godlike V-shaped recovery and went to all-time high ever since. The effect of money printing was huge, so much so that 80% of all US dollars in existence were printed in the last 22 months. This is their money supply. At first, it was going up slow and steady from PP. Then in 2020, boom, the money supply suddenly went to the moon. So the market partied all the way in 2020 and 2021. But on December 15, the Fed suddenly announced that they will stop their money printing machine, aka stop buying bonds in March. Then after that, they will start increasing the interest rate. If you check the charts, since December 15, the S&P 500 has been going sideways. It touched 478 and be like, Happy New Year! And started going down. Okay, maybe you are blur and be like, but why does increasing interest rate cause the market to drop? Okay, here's why. When the risk-free rate is lower, people tend to invest in riskier stocks. But when the risk-free rate is higher, people prefer to invest in safer stocks. The explanation is very simple. When interest rates are low, people can borrow money very cheaply. Ever since March 2020, people have been borrowing more and more money to invest, almost doubling from $479 billion all the way to $918 billion. That's why you see so many meme stocks popping up in 2021 like GameStop, AMC, BlackBerry, because people had more money to YOLO into stocks. However, now when interest rates increase, people will start selling off their riskier stocks. Stocks like Shopify, Roblox, Moderna, Netflix, Snapchat, Robinhood are all down by almost 30%. In comparison, value companies like Coca-Cola, Bank of America, Pepsi, P&G, 3M be like, huh? Crash? What's that? Can eat one? Now, as to why the Fed wants to increase the interest rates now, the answer is very simple. Inflation. So, because of the pandemic, there's supply chain disruption, worker shortage, and as people were stuck in their homes, they spend more. All this led to companies raising the price, like Netflix increasing the subscription cost, IKEA increased their price by 9%, Big Mac costs more now. Even the dollar store increased the price to $1.25. All this led to inflation reaching 7% last month, highest since 1982, when all the boomers were still boy and girl. So because of these reasons, the Fed wants to increase the interest rate in order to slow down the inflation. Also, another reason why the market is going down is because of slowing growth. For example, in Netflix recent earnings, analysts are expecting 6.93 million subscriber growth in the first quarter this year. But Netflix be like, nah man, we are only expecting 2.5 million. Compare that to Q1 2020, when subscriber growth was at a godlike 15.8 million, then in Q1 2021, it dropped to 4 million. This was because during the pandemic, when people couldn't really travel, they had more money to use. So they were able to buy more stuff and subscribe to Netflix and stuff. However, after 1 year, people had already bought what they wanted to buy, and they are slowing down their spending. This led to a 1.9% decline in retail sales. And just so happens that a lot of companies will be reporting their earnings this week, like Microsoft, Tesla, Apple. Many investors decide to just sell, then wait and see other companies report slowing growth or not. If that's the case, the market will go down even more. so now, will there be a crash? Well, it depends on who you listen to. On one hand, you have the rich dad poor dad saying stuff like the biggest stock market crash is on us now. Michael Burry warning that the mother of all crashes is coming. Personally, I don't like to listen to random sohais or idiots warning about crashes, because if there's anything I learned, it is this: people who warn of crashes coming totally don't know if a crash is coming or not. For example, Michael Burry has been warning about a crash since 2015. If you had listened to him, you would have missed out on a godlike bull market. Or the Robert Kiyosaki guy who has been shouting about the market crash every single year during the entire bull market. In short, no one can predict when a crash is coming. But let me show you some real data, because science. In the past, when the Fed cut the rate, S&P 500 had went up by an average of 21.2%. In 2001, it went down was due to the dot-com bubble, and 2007 drop was due to the great financial crisis. Now, that's expected, right? When rates are lower, companies can perform better, leading to higher increase in stock price. Now, check this out. During a rate hike, on average, S&P 500 had went up by over 62%, almost 3 times compared to a rate cut. However, you need to know that 2022 won't be a smooth ride. According to historical data, this is how the S&P 500 performs 3 months before a rate hike versus 3 months after a rate hike. Before the rate hike, all the sectors are doing well. But 3 months after a rate hike, most of the sectors tend to perform badly, except for energy, communications, utilities, and real estate. Here's the interesting thing: even though there are pullbacks, it is still possible to get a positive return at the end of the year. Like in 2014, the market dropped by -7%, but still gave a 14% return. Will 2020 give a positive return, or will it give a negative return? I don't know. All I know is this: bull markets happen a lot more times than bear markets do. And even if there's a bear market, over the past 120 years, there's only been few times where the market gave more than negative 40% losses. On average, the market has gone down by only 17%. So what I'm trying to say is, you don't have to worry, because if you are a long-term investor, as long as you hold good stocks, you'll be alright, because stonks. Some people be like, if I sell now, then I buy the dip, I will what big. Can, but you wait long, huh? A study found that average investors tend to time the market wrongly and will usually underperform the market. This means instead of having perfect timing and getting the best returns, you will most likely underperform some random guy who just dollar cost average in the market consistently. So all this just points to a very simple fact that most of you already know. Don't worry about market crashes. Like Matt Damon says, fortune favors the brave. Instead of trying to time the market, what's more important is that you buy good stocks. You know, those companies, they have very strong balance sheet, high earnings, low debt, great competitive advantage, good profit margin. Companies like Apple, Microsoft, Google, Amazon, and yes, even Tesla. Yes, some of these companies may be overvalued now, but when a crash comes, you can buy these companies at a huge discount. No one knows when or how long the market crash will be, but the point is, it doesn't matter. What's more important is Warren Buffett's quote: be fearful when others are greedy, and greedy when others are fearful. As long as you buy good stocks, consistently dollar cost average, and hold long term, you'll be alright. As for myself, here's my plan. During this whole market correction, I realized something. Other than Tesla, all my other stocks are in the red, like Square, Lemonade, Arcade, ArcG. And that's why my channel name is Kelvin Learns Investing, not Kelvin Learns Investing. This time, I learned that I've been investing like an ape, where I throw money into random stuff that I thought can go to the moon immediately. So here's my plan for those stocks. I don't have high conviction in them, and because of that, I plan to liquidate these holdings, then use the money to buy stronger tech companies that I'm more confident in, like Google, Microsoft, Apple. As for Tesla, I still have very high conviction in it, and will continue buying in. I won't even try to time the dip because I'm super bad at timing stunts in LOL. And I know I will also start at market timing. Instead, I will just dollar cost average into it as usual. Market go up, I buy. Market go down, I buy also. So simple. I also won't be adding any more cryptos for now because I intend to hold just 10% of cryptos in my portfolio. So that's my plan for 2022. Hopefully now, after watching this video, you have a clearer picture on how to invest and will hopefully come out on top when all this is over. Anyway, that's all for today. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.